Hi, I'm Dan Danford. I'm doing a series of podcasts for DadsDivorce.com called Money Made Easy. This week's question from a viewer is a very, very good question. Can you explain money markets to me, and when would it make sense for someone to put their money into a money market fund? You don't have access to your money when it's in a money market fund for X amount of time, right? Well, wrong, actually. Let's talk a little bit about money market funds and money markets and see if we can't make some sense of it all. The most important thing is to distinguish between what's called a money market account at your bank and a genuine money market fund. Okay, a money market account at your bank is probably something between a checking and savings account. Probably what it does, it may have a minimum balance. They may say, hey, you have to have $5,000 or $10,000 in this account. And it probably has a limited number of deposits or withdrawals that you can make in the account. So it's probably a fairly large savings or checking account. And for making that agreement that you're going to leave a large balance there and not write very many checks or make very many deposits, they pay a higher rate of interest. And usually the interest in one of these money market accounts fluctuates. Okay? It will fluctuate sort of like a savings account does or something like that, only it's at a slightly higher rate because it's a larger amount of money. Okay? So that is what's called a bank money market account. Now, a genuine money market fund is actually a specialized type of mutual fund. So the easy way to understand that is maybe I send my $5,000 in and you send your $5,000 in and a whole bunch of other people send $5,000, $6,000, or $10,000 in, okay? Now, all that money is pooled together and invested, and it's invested in very short-term bonds, basically, or treasury bills, okay? So all of these bonds or treasury bills mature in 3 to 6 months, say. So all of us who own part of that portfolio get to share in the interest from those corporate or government bonds, okay? And we all get to share in the interest based on our portion of the account. Now, two things make it really unique, because what I've described so far could be almost any mutual fund that just invested in bonds or short-term instruments. Two things set it apart. One is that the interest that we share is determined every single day. So if I send my money in today and then I take all my money out again 3 days from now, I will get my prorated share of interest for each of those 3 days. Okay? So that is done every day of the month for every single shareholder in the fund. Okay? So, if you send your money in and it's there for 5 days or 10 days or 2 years, then you will get that. They calculate the amount of interest you're due every day and they pay that once a month. So you'll get whatever you're due. So even for my 3 days, I deposit the money. I let it sit there for 3 days, then I write a check for the same amount of money. Come the end of the month, they will pay me that interest for those 3 days. Okay, so a really sweet deal. It's a great place to park money for short periods of time. Now, the other thing that makes it unique, and this is really what makes a money market fund special, is that they try to keep the share value at $1. So if I send in $5,000, typically I own 5,000 shares, okay? And that $1 price per share doesn't fluctuate, okay? Now there's no absolute and total guarantee about that, but the way they do their fund accounting and the way that they compute such things is all geared towards keeping that dollar per share price in the money market fund. Now, in the 30 or 40 years that money market funds have been around, there have been a couple of instances where the share price in a particular money market fund has what they call busted the buck. Okay? So in those situations, there were some purchases, or there were some shares, not shares, there were some bonds in the portfolio that basically didn't hold their value. And so the shareholders, during a particular period of time, their share value went from $1 to 98 cents or 97 cents. But like I said, with thousands of mutual funds over 40 or 50 years, that's only happened on a few occasions. In most cases, the kinds of investments in these money market funds are short-term, highly reliable investments. So the likelihood of you losing principal value is very slim. Now, the major advantage to a money market mutual fund is, number one, the higher returns. In other words, we all get to share on the interest from those investments, okay? Usually the manager of the money market fund makes a little bit of money for managing the portfolio. So let's say they take out 0.25% per year, okay? So the rest of us get to keep all but that 0.25%, and it's shared between us on a daily basis. That's a pretty sweet deal, because when you go to a bank, and today is maybe a little bit unusual environment, and believe me, I'm not saying anything bad about bankers, it's just the way the system works. Their spread is actually much larger than that. So if they're going to make 2% on the money or 3% on the money, they're going to pay you 1% on the money. So in a money market fund, since somebody's just taken 0.25% for managing it, your potential returns are higher. Now, there's one other scenario that I think is worth noting, and that is, especially in a rising interest rate environment. As interest rates rise in the economy, all those instruments in the portfolio start earning higher interest rates too, and then that passes on to all the shareholders of the money market fund. Well, that's a different scenario than what you see at the bank. At the bank, the spread may go up. I mean, the banker may be able to earn more than 3 or 4% on the money, but their incentive, their profit incentive, is to keep your returns as low as possible. So I'm not saying there's anything bad about that. That's just how their system works. It's profitable for them and it's safe for their depositors. But they don't have the same incentive. You don't share in the gains as readily in the bank as you do in a money market fund. So a money market fund in many cases is a very good way to go. Now, one last point. There are hundreds, thousands of money market funds. Most mutual fund complexes may have 3 or 4 different money market funds that they offer. Kind of a key to this is there's 2 variables that are really important. It's what they invest the money in, the quality of those bonds. The higher the quality, the lower the return, and the higher the safety. Okay? And then the other thing is, sort of the convenience. So what I like to do is I like to tell people, if you're going to have your money at a particular brokerage firm, you can probably choose between 2 or 3 different funds. Choose one that's probably somewhere on the medium quality spectrum. That'll also get you a little higher returns. In all likelihood, even the one that's on the lower quality spectrum, because of the money market rules and the fact that they're going to try not to break the buck, is probably going to get you a higher return and be a good and safe investment. But in general, that's what you ought to do. I don't recommend, choosing some other money market fund someplace simply because it pays a higher rate. It's probably not very convenient. It's true you might be able to get an extra 1/4 or 1/10% by doing that, but who wants to deal with a money market fund halfway across the country just so you get an extra 1/10%? Convenience does have value, and so I suggest that you just choose the best money market fund that's available to you within, whatever palette of funds or whatever that you're working with or your brokerage firm. In any case, I hope that clears up some questions about money market funds. Like I said earlier, I'm a big believer. I just love money market funds, genuine money market funds, and I'd encourage you to check them out if that isn't already part of your investment portfolio. That's it for this week at Money Made Easy. We'll see you again next week.